Well, hello everyone. Welcome to Trading a Smaller Account. My name is Barbara Armstrong. I'm a coach with Schwab. And today we are going to talk about condors, specifically iron condors. And if you're new to the world of trading or you are new to this strategy, don't panic. Don't say, okay, this is, not a strategy I'm familiar with. This is kind of going to be one of those everything you always wanted to know about iron condors, but were afraid to ask kind of class. And if you're a beginner to this strategy, you're in exactly the right place. So we're going to look at a bit of trade management with iron condors because we have 1.5 iron condors on now in our example account. And I'll explain what the half is all about. And then we're going to place some new trades, and we're going to look at some of the nuances in trading this strategy, which I affectionately refer to as a credit spread sandwich. So thank you very much for joining us. I see a lot of the usual suspects in the chat today. We also have Connie Hill joining us, and she is a friend and fellow coach in the chat. So if you have questions, don't hesitate to ask, and between Connie and I, we'll have answers for you. So hello to Vincent and John and Chris and William and Tan and Greg and Alfred and the rest of the gang. It is fantastic to have so many of you here and on board and participating. If you are new to this class and joining us for the first time, please know that we meet every Monday and Friday at high noon. I also teach the trading price pattern class on Wednesdays as a companion to this. So you're welcome to join us for all of those. We start the year with an account and trade that example trades in our paperMoney account throughout the year. Somebody's asking why an iron condor is called an iron condor, and I really have no clue. Nobody asked me, or I would have called it a credit spread sandwich, but I guess that doesn't sound as official, right? So if you are not following me on X, consider this your formal invitation. My handle, Barbara Armstrong CS. Connie Hill posts a lot of great content as well, and you'll want to follow her, Connie Hill CS for Charles Schwab. Just know that there are scammers about again of late, so know that no coach will ever reach out to you and offer you a Bitcoin or crypto deal, private education for a fee, or perish the thought, say, hey, why don't you give me access to your account and I'll trade it on your behalf and we can split the profits. Yeah, these are thieves and scammers, so please be careful. But having said that, you don't want to miss all the great content by participating. So yeah, please follow along. Know that options carry a high level of risk. We're talking about options in this class today, and they are not suitable for all investors. You have to apply for option trading privileges with Schwab, and not all will qualify. We use the paperMoney software application on the thinkorswim desktop. It is a brilliant place to learn, to become familiar with how to trade or invest using this platform, and to make sure that you understand a trading strategy and you've practiced it and you know what you're going to do, both if the trade goes for you or perhaps even more importantly, if the trade goes against you, before you consider trading it in a live account. There are some nuances and differences. One is that short option positions will never be assigned early in paperMoney. That can happen in a live account. And, the strategy we're talking about today involves both short options or options that we sell and options that we buy. So we started the year with 25,000. Our max position size is 5,000 and our max risk per trade is 500. Our focus in this class is primarily on a short to intermediate term time frame. Okay, and we're looking at both bullish and bearish opportunities. And today we're looking at kind of bullish to neutral or bearish to neutral. We're looking at a strategy that really is strongest when a stock is moving in a sideways direction. So it's kind of neither bullish nor bearish. And so that's what we're going to focus on today. And we haven't looked at this strategy a whole lot. Like last year, I don't know if we did an Iron Condor trade because the market was very bullish. And even though the market has hit all-time highs, the S&P 500 and the NASDAQ this week, there are a number of stocks that have been, kind of going sideways. And so since I saw some opportunities, I thought we'd talk about that today. Now, if you have never been to a live event, the next one, and it's a 2-day workshop. The first day is technical analysis, focuses on looking at the charts. The second day is an introduction to options. That's happening in Scottsdale at the beginning of March. Then we've got an advanced options class coming up March 21st and 22nd. This one is already filling up fast. I will be at this event, so if you come, and please do, if you come to that event, please come up and introduce yourself. I would love to meet you. And then we're doing another one of these advanced options 2-day workshops in Detroit in April. So you have the advantage, because you're coming to this class, at kind of getting first dibs before this is promoted through email, and registration is filling up fast. So if you are thinking you want to come, I'd register sooner rather than later for these things. And how do we do that? Well, you're going to come to, and Connie will put this in the chat. I'll also put it in the show notes. But if you come to schwab.com/coaching, and then you come to in-person events, and we have stuff, if you want to start doing some planning, you can't necessarily register, past the end of May, but we have an event coming up in Anaheim in May, another 2-day advanced workshop. But, we've got, we're going to be in Miami for a market drive in June, and then in New York. And this one will be right in Times Square at the Marriott Marquis downtown. So, we have things laid out right through the end of the year. December 19th is the last one, an advanced options workshop in Miami. So if you want to do some planning, even though you can't register necessarily through the end of the year, you can put that stuff on your radar. Okay, so let's get out and start talking about Iron Condors. Okay, so I want to talk about the one that we have on. It actually is expiring today. And the idea, if you're new to Iron Condors, here we go. If you're new to Iron Condors, the idea is when we see something going sideways like Dollar Tree has been, we sell a short call vertical, which is a bearish to neutral strategy up here at the top. So we're selling a call and then we're buying a call to help define our risk. Because when we sell a call, we're saying that we're agreeing to sell shares of Dollar Tree at $77 a share and 100 shares per contract. And we don't own any Dollar Tree. So if somebody called us on that and said, okay, I'd like to buy 100 shares from you of Dollar Tree at $77, we'd have to go out and buy it in the open market. And so just in case Dollar Tree took off, if it went up to $90, we'd have to go out and buy it at $90 and then sell it at 77. And so we sold the 77 and then we bought the 79. So that we're defining our risk. And then on the bottom side, we come down here and we sell a short put vertical, which is kind of bullish to neutral, so that as long as the stock stays above our strike, we're good to go. And so what we really want this stock to do is to continue to go sideways like it has been doing. So what is the great appeal of this is that we're taking $2 worth of risk, but we're being paid twice. We're receiving 2 credits. And what do I mean by that? Well, when we do a short call vertical, we receive a credit on this side, and then we receive a credit when we sell the short put vertical. But there's no way that this stock, even if it moved dramatically, it could go through these strikes, it could go up, or it could come down, but with expiration being on a specific date, there's no way it can compromise both trades at the same time. And so we're receiving 2 credits for the same amount of risk. And this is why, this strategy is appealing for some people. But the gotcha on this is that the stock has to continue to go sideways until expiration or until you exit the position in order for it to be profitable. And so we actually were going to layer in a trade last Friday on Dollar Tree, a second trade, and it expired. So my bad on that I didn't check to make sure it got filled, because it would have gone along just swimmingly and we would have had a week of time decay. So we're going to look at our Dollar Tree trade. So let's just close these so that they're less distracting. So when we look at Dollar Tree, days to expiration 0, and it's worth very little, but we're still in the trade. Why is that? Well, sometimes when you get close to expiration, there can be less liquidity. So it's saying that this isn't worth anything, but it's still not getting filled. So could we just let it expire worthless? We could, but I just want to show you another way to exit this position, because you don't want to ever say like never, right? So we're going to come to the monitor tab. So we canceled our exit on that. We're going to come to the monitor tab and we're going to just highlight this whole trade, right click to create a closing order. And we're going to say, we want to close out that put vertical by buying it back. And it's saying it's only worth a penny. Well, you know what? We're willing to pay 3 cents. And there are typically, if you can close out a vertical for less than a nickel, there are often, the transaction fees might be waived depending on your broker. So we're going to send this in. And the goal is just to officially close out this trade. And then we're going to come back here and create another closing order. And what we want to do is buy back the call vertical. And again, this is also saying that it's not worth anything. And so we're going to say, well, because these numbers are minus, like what if we paid 3 cents to buy that back and close it out? And so we'll send that in and see if that fills. So that's another way of looking to close out a trade. So there we're out of our call vertical, the call side. So now we can see that quantity went to 0, and we're still not quite filled on the put side, but we'll let that go. Now, could we do a wash, rinse, repeat on this? And might we want to leg in? Now, last Friday, and where's my calendar? Let me just grab it. So last Friday, when we had attempted to put in a trade, we were kind of closer, to the middle. We were closer to here, right in between our 2 strikes. And now we're up close to our resistance level. And so chances are we get more premium if we sell the short call vertical now. And it came up and it had a big day yesterday. You see, we have these, big long tails, but today we have, this bearish candle. So what if we came and it's at 75.23? What if we came and we sold this 77.79, the short call vertical piece? And then when we meet on either Monday, Wednesday, or Friday of next week, we could leg in and add, the short put vertical piece to it. And that's called legging in to an Iron Condor. And when is our earnings coming up? March 19th. So if we look at the monthly on this, where we have thousands of contracts, we can do this, but the 21st is earnings. And so with this one, we might not want to wait until we have 80%. We might say, hey, when we have 50% of our max gain, because we definitely want to be out of this prior to earnings, which is on the 19th. And if we go out to the monthlies. Now, if we look at March 14th, we do still have hundreds of contracts, but the bid-ask spread at 60 cents, that doesn't meet our trading requirements because it's more than 10%. So we'd want to look at this March 21st. And, you know, what's one of the kind of downsides of that is that then we either have to do the 75, which is where it's currently trading, or the 80 strike, you know, which is, we were willing to do the 77, but we don't want to, you know, sometimes we don't get exactly what we're looking for. And so let's see if we can get enough at the 80 strike, you know, for this to be worth our while. Well, if we're getting $1.40, you know, that would meet our trading requirements, even if we were just doing the short call vertical. And what do I mean by that? Well, let me come and switch this to a calculator. So what are we risking here? Well, we're risking $5 minus the $1.40. So $1.40 divided by 360. That's 30 and a 38% return potentially for a trade we'd be in for 28 days. So we're going to put this in and we're going to say, hey, if we can make 50% of our max gain on this one instead of the typical 80, then, you know, we'd be happy campers. And what we'll do is, the intention is, if this pulls back or when this pulls back, to then add in the short put vertical piece. Because right now, if I looked at adding the short put vertical at 70, well, let's just see how much we would get. So 310, 325, we have almost 10,000 contracts. We have a delta of 30. There might be enough actually that we get $1.47 on that side if we sold the 70. What if we sold the 65? You know, which is down even further away. We get 87 cents. And so between the two, we get almost 250 on that $5 wide strike. So let's go ahead and do that. We're going to come in, we're going to right click anywhere on here and say that we want to sell an Iron Condor. And it will just assume, you know, the strikes that it thinks you want. So here's the 80 and the 85, it will give you the next closest. And then on the put side, we want to sell the 65 and then buy the 60. And so we're receiving 227 as a credit. Now, could we still wait if we wanted? We sure could. What's the advantage of putting both sides on now is that we get the time decay over the weekend. I chose, somebody's saying, why did you choose not to sell the 75? It's because it's trading at $75 right now. And by going up to 80, it just gives me $5 worth of wiggle room. It gives the trader $5 worth of wiggle room, you know, or a buffer before the trade is compromised, because we want it to stay below our strikes. We want it to say below our call strikes and above our put strikes. So the wider that we can make the channel, the higher the probability of success. Now, the lower the premium we'll receive, but at 226, So if we look at that, 226 minus, what is it, 274 divided by 274. Sorry. Well, let's call it 230 divided by 270 is what we're risking. $5 minus 230. So that's a potential 85% return on our risk. So when we look at this, you know, we could lose $271. The most we can make is $229. You know, and if we don't want to risk more than $500, how many of these are we going to do? We're going to do one. Because doing two, we'd be risking 540. Okay. And we're going to say, hey, when we've got half our max gain, so when this is worth, you know, $1.15, we'd like to buy it back. Now we typically put an exit at 80% of our max gain. So why aren't we doing that? And it's because the expiration on this is 2 days after earnings. So we want to be out prior to earnings. Now, someone else is asking a question that I really like. You know, how far out are you normally looking to go on an Iron Condor? And some traders, part of their example trading plan, and I haven't put that in our trade management mini session yet, so stay tuned for that. But here's our first trigger sequence, opposite order. If we go out 21 days, this one we're looking at 28 days, the closer you are to expiration, the faster time decay kicks in, or the more accelerated it is. So you receive less premium, but then your chances are you can be out of the trade faster. So we'll look at another example, and I'll show you sometimes the difference. Sometimes we go out twice as far and we don't get anywhere close to twice the credit. And so the thinking is, you know, that maybe we can do 2 20 to 30 day trades instead of 1 50-day trade. Okay. So we are going to put in an exit when we've got half our max gain. And can we change our mind on this? Absolutely. So that would be $1.15. So half of 230, and we're going to make that good till canceled. And then we're going to put this in our Iron Condor bucket. And the reason for the 50% exit target, a note from us to us, is due to expiration 2 days after earnings. So we want to be out earlier rather than later, because as we approach earnings, volatility tends to go up. And when volatility goes up, the price of the options go up. And what we want this to do is decline in value. Does that make sense? Okay, so I've teed that up, and today I really will make sure that we get that one filled. So it's just kind of waiting to fill at the moment. Okay, so let's look at, now we did one on Micron earlier this week, and we said we were going to leg in. That's why I said we have 1.5, and we're up 18% on this. So we've got the short call vertical side in on Micron. So here's our short call vertical side. Where do we want to put the put vertical? And so this one too, like, you know, it comes up like this expires 1 day before, 1 day after earnings. So we want to be out of this one too. So could we come down here and add in that 85? You know, I don't know if we want to go to 90. We could, but could we sell the 85 now that it's come down for another couple of days and get enough premium? And so if we come out here, we want the time frame to stay the same. You know, we've got thousands of contracts on Micron. Could we add in our vertical? And if we get 64 cents, I know that's on a $5 wide spread, but we're adding that to the dollar, what was it, $1.40 So now we're at $2. So I kind of look at it as kind of beats a poke in the eye with a sharp stick, right? So if we add this in and, we can, add our exit on this afterwards, we're going to put that in our Iron Condor group. And how many of those did we do? Sorry, let me just come back here. We did 2 of these. Okay. So we're going to come to the trade tab and make this match. We're going to sell 2, confirm and send, and put that in. And so it's saying, we could lose $874. Well, that isn't taking into account the credit we're receiving on the call side. And then the most we can make on this is 126 for our 2 contracts. So we've added that in, and now we've got kind of both sides of our credit spread sandwich on Micron. And so the second piece of this is now that we have the short put vertical side at 85 and 80. Oops. And that's expiring March 21st. And we can show that on the right. And so as long as this stays, below, so the goal here, and I'm going to put another circle on, we can add another circle here, but the goal is that this stays below, excuse me. So we want this to stay below our short strike of 110, and we want it to stay above our short put strike of 85. And as long as it kind of wanders along in here, we will be happy campers. And again, we want to be out prior to earnings. And so, if we're up 50 or 60% on any one side, even 25%, it certainly, as I like to say, it beats not having placed the trade, that's for sure. Yeah, so we could set this up. So somebody's saying, will the 2 trades combine so that we can sell it as one trade? And if we, just let me erase this. So it's showing as 2 verticals, but we could put in 1 exit. I think we could at least. Let's see, create closing order. No, it looks like, sorry. Let's see. Yeah, so it looks like we could say, hey, we want to buy back this whole thing. And we could do it that way also. So this one, we're just going to let this percolate over the weekend, and then we'll come in and we'll look at this again on Monday. So somebody's also asking, what consideration I'm giving to volatility. Well, one of the beautiful things about volatility is that it makes the credit richer. And so that's appealing. But there's more risk. That's why there's more volatility. So you're kind of dancing with the devil. If you're trading something where volatility is very low, your premiums are just not going to be as high, but chances are the stock is likely to be less volatile. So let's come and look at another one here. So if we came and we looked at, and I'm seeing more kind of legging in opportunities. So here's Intel, and Intel, since August of last year, has been trading in this range between 19 and kind of 26. So right now it's at 25.48. And so could we leg in, and we're just on the other side of earnings here, so we don't have to worry about earnings. If we came out to March and we looked at buying the 26 and then selling the 27.50 because we only have, dollar wide strikes. Here we have dollar wide. We could do the 25 and the 26 if we came out 35 days. Now, why don't we want to come out 21 days? Because if we're only putting on the short call vertical side, then, we'd prefer to have maybe a little more time. But we have lots of contracts even on these weeklies. Even if I come out here to March 28th, which is giving us 35 days. So, and the disadvantage of the monthly is that there isn't a $27 contract. It's only $27.50. And there's not a 28 contract available either. So if we come out here and we do the 25 and say the 27. So let's look at, if it's a dollar wide, the 25 and the 26, we get, we don't want 25. We want 26 and 27. Sorry. 26 and 27. Oh, I'm going. So we get 40 cents for that. Now, so we're risking 60 to make 40. Now, if we come out here to the 28, we're getting 60. So we're getting 50% more, but we're doubling our risk. Do you see what I mean? So we're not getting double the credit to take double the risk. Which is kind of interesting, isn't it? So this can sometimes impact, how wide we want these to be. And then if we look at this one on this day, it did come up to 27 and close there. So maybe we want to be more conservative and say, okay, instead of doing the 26 and 27, how about we do the 27 and, and the 28 or the 29. So we get 26 cents. So that's a 30-some% return for a trade we'd be in for 35 days. And then the expectation is that we add the short put side. But if right now we tried to come down to 19, I don't even have that many strikes. See, we've got no premium here, only 7 to 9 cents. So unless it comes down far enough where, if we're closer to at the money, we're seeing 90 cents, 55 cents, so this is why we would want to wait. And so if we're looking at this even just as a standalone, how much are we risking? Well, we're risking 66 to make 34. So that's close to a 50% return on our risk. If we're risking 66, how many contracts could we do? Well, if we take our $500 and we divide that by 66, we could do 7. So we're going to come in here and do our 7 contracts with the expectation being, God, these numbers are all over the place. Now we're risking 70 cents. So okay, so $5, well, we're risking our $500. And then that will be cut when and if we add the short put vertical side. Okay, so I'm going to put this in the Iron Condor group because the intention is to leg into the short put vertical. And that's what is driving our decision to choose this further out date, as opposed to something, if we were putting the entire trade on, we were closer to the middle, then we might choose something 21 or 28 days out as opposed to 35. Does that make sense? Yeah, and so often people will try and look for a delta, which is a probability of it being in the money between that 20 and 40. The closer you are to 20, the more the higher the probability that the trade will expire worthless. But, and these numbers are based on where the stock is currently trading. So we're going to see a higher delta. This has a delta of 40 at 27, but this is trading $1.50 above. So here's our strike. When we, did the 27 and the 28. So here's our short call vertical at 27.28, and it's March 28th. And we're intending to make this an Iron Condor. So I'm going to put IC at the front of it. Okay. And so we've just put the first piece on, and we're looking to add the second piece, if it pulls back, if and when it pulls back here. Okay. So that's Intel. How about Microsoft? So here's one that is closer to support than resistance. The other ones were bouncing off the ceiling or resistance. This one is bouncing off the floor or support. And we did have a short put vertical here that expires today. We got out of that yesterday and got out for 80% gain. How do I know that? Because I came here and I checked on it on the account statement. And so we got into that trade for a credit of $75. We had a 250 wide spread, and we exited, for 15 cents, which was our 80% target. So when we come back to the chart, we can now take that one off because we're now done with that. And we can look at it and say, hey, it's come down to this 406 level a couple of times. Could we sell the 405? And what's the advantage of selling it on a day like today when in fact the stock is down a little, is that it's closer to this support level. Now, some might say, well, wouldn't you rather wait? And we could do that. But let's just see out of curiosity what kind of premium we'd get if we came out. And where are we on earnings? We just had earnings. So earnings isn't until April. So could we come out this 28 days, and if we sold the 405, and our example trading plan, does this stock trade at least 1 million shares a day? Check. Do these options, have at least 20 times the number of contracts we're looking at trading? Well, we're looking at doing one or two. This one has 4,000 contracts, a 10-cent bid-ask spread. So, that was another parameter. So if we look at 405, it's trading at 413 right now. So could we come in and leg into this potentially? And, the credit would be $1.45. And this is for something with a relatively, lower at the volatility end of the scale, especially for a tech stock. So if we look at this and say, okay, well, would that stand alone even as a short vertical? Well, 145, what are we risking? If I take 145 minus the 5, we divide that by, 355 is what we're risking. So that would be a 40% return for a trade we'd be in for 28 days. So if we're cool with that, how many of these would we do? We'd do one, because risking 2 would be over $600. Now we could come in here and put our exit in. We aren't earning sensitive on this one. So we could say, hey, when this is worth, 28 cents, or 29 cents, we want to buy it back. Now, we can change this when we add the Iron Condor, or we can be as willing to leg out as we are willing to leg in. Yeah. So that's our, and the reason we're putting this in the Iron Condor group, even though it's currently a short put vertical, is the intention is to leg into an Iron Condor by adding the short call vertical. Okay, so we're going to send that in. There we go. Now, if you wanted to continue to practice this, what else might you look at? We could look at TSCO. There's another one. Now, this is a little different in that it's been trading in kind of a diagonal channel, but is it pulling back today? So could we add that short call vertical piece on today with the intention of adding the short put vertical piece later? And the answer is yes, we could. Now, I've talked a little bit about trading plans. And so I don't have an Iron Condor trading plan in here yet. So, you know, it's coming. But this is why you want to subscribe to the channel. If you haven't subscribed already, if you hit the subscribe button, then it just, you'll have it in your list so that it'll be easy to find this content. And there is a playlist for each and every class that we regularly teach. If you come down here, these are all little sessions that I've just recorded that I think you'll find helpful. There are 2 on the power of compounding, which if you haven't listened to them, you may want to check those out. I'm such a big proponent of financial literacy and in automating savings. So, and this is something you can share with people who know nothing about the markets, and it may pique their interest. But here are these example trading plans, and there's one for the short put verticals that we layered into today, and then the short call verticals. And stay tuned. The next 2 example trading plans will be one on a stock investing plan, and then we'll do the Iron Condors. And then if you are new to thinkorswim, there's a whole pile of just quick and easy, you know, how to customize your monitor tab or your charts or a watch list, all that kind of good stuff. Okay. Okay, so I'm just having a quick look at the chat. And then these ones in orange, because we've covered the blue, these ones that are in kind of tangerine are the are what I originally set this up for, which was looking at some of the positions we've placed. And sometimes we'll do 2 or 3 trades on one stock, or we'll have done 3 different short put verticals. And rather than covering the post-mortem in class, I'll do it in here. And I always post these on X once they have come up. So that's what I had for you today. Iron Condors, and you know, the ability to both leg into Iron Condors, leg out of Iron Condors. It's a way that we can take advantage of a stock that is going sideways and use that as a way of generating potential income in our portfolio. Now, do these always work out? They do not. And we have to plan for that as well. But I appreciate you being here with me today. Thanks for subscribing if you haven't done that already. Don't forget to follow us in the land of X, Connie Hill CS and Barb Armstrong CS. Hit the like button. It's your chance as you head into the weekend to do a favor for a stranger whom you may never meet, you know, because it helps raise this in the YouTube algorithms. It also, as Cameron May says, sounds like applause to us and is an indication that you enjoyed the content. And so that's a wrap. I think I've covered everything. I don't believe that there was a survey today. So thanks to Connie for fielding your questions in the chat. Thanks for so many great questions in the chat today, guys. We very seldom spend an entire class on one topic. Oh, and if you didn't look at Internet of Things, we'll talk about that on Monday, but I had to chuckle because we said, you know, never say never. And then after we got out of our position on, I think it was Monday, the stock, yeah, had a really huge down day. So anyway, we'll look at Internet of Things, or IoT, Samsara, again on Monday. Have a really awesome weekend, everyone. Get out and hug someone you love. Thanks to the guys behind the scenes for helping bring this to life. Take care, everyone. Bye for now.